I don't feel like I have anything particularly interesting to say today. That's why I'm asking.
We'll find something. All right, we're back here in Chicago at the Cboe trading floor, getting ready to go live, 2 p.m. on a Friday, a little special Friday with markets coming off a little bit. VIX right now, we are at 17.9 high for the day, but back to 16 currently. So a little bit of calm kind of coming back in after some selling. Market did put in all-time highs on a closing basis yesterday. The S&P 500 right now down 1%. So definitely a little bit of a chop, but doesn't seem like too much trouble. Some concerns about maybe some AI spend getting pushed out from Oracle, Broadcom getting hit as well. But, it's not the worst. You got Bitcoin down about $1,600. Master down 2%. Market's been cruising. I'm not too worried about it. Bonds selling off is kind of interesting. We did talk earlier about the potential for the 10-year yield to break through 4.2%. Good show coming up. Brent Kochuba, Noel Smith, and Scott Bauer starting in a moment.
Hey, Oliver. I didn't want to interrupt you, but you weren't muted.
That's for the TikTok, by the way, folks. Good afternoon. Welcome to Chicago. Future of Finance. I'm Oliver Renick. We are back live here at the Cboe trading floor on Jackson and LaSalle in Chi-Town. It's a little bit chillier than it was in Vegas. I had a fun time at the Prosper Trading Conference, and I had a good time at the Win. Right now, we're looking at stocks coming off a little bit. Equities under a little bit of pressure, but we just put in closing highs for the S&P 500 yesterday, so I don't think we're too worried about a lot right now. Looking at the market, though, we have been chopping a little bit, not just for stocks in the tech category, but obviously crypto too, which is a little bit softer. Still, this has been a pretty good-looking chart. I'm not too worried about. Here it is right now, the S&P 500, as you can see, basically just going back and forth in this range. We'll call it about 85 points or so, between 69, 68, 15. Pretty sizable candle, about the same as the last two, that kind of broad range from 69 down to 68.20. It's obviously not an ideal situation. We've got a few big names dropping off. Look at Broadcom getting hit right now, and that's one that has been an important uptrend and a leader. So a little bit of shakiness there. The SMH doesn't look too hot either, with the big red candle pulling back. But again, another one that just put in highs too. So higher highs generally is what we look for in the trend. Keep in mind, we also had the Russell and the small caps, which were extending and really leading over the past several sessions, those giving some back as well. Again, I think the fact that you put in the higher highs for a lot of these is important, because it does tell us that the trend generally is your friend and still in favor. Risk radar yellow for stocks until we get a intraday all-time high. We were so close on the S&P 500. We got the record. I'm so used to thinking about futures as well as the intraday trade that when I heard folks yesterday talking about the all-time high in stocks, I was like, what are you talking about? Because I'm a candle guy, I really am. On the line charts, we put in the all-time high, but don't forget, obviously, there was an intraday level that was above that. So that's where I think we do have to have a little bit of respect for that 69.20 high from October. Haven't quite gotten through there yet. Now, the other thing that's important as well, though, is what's happening in the bond market, too. Notably, the 10-year yield doing something interesting, which is rising today. Here's a chart that we spent some time looking at last week. You've got a line at 4.2% that's held both in the past and recently. It was old yield support, bing, bang, boom, bam, basically all the way back to May. And then it was yield resistance here after we had this long downtrend in the 10-year yield. It was resistance and yield to the upside. Of course, I mean support for price. People were buying bonds basically every time we got to 4.2%, pushing the yield back down. But now we're fighting for that as an actual breakout, meaning weakness in price for bonds and strength in yields. Now, that is very interesting, obviously, because the Fed just cut, but as I've talked about before, don't forget the bizarro bond world, which means when the economy is strong, jobs are generally still pretty solid and people are spending. Vegas was pumping. The rodeo, my goodness, it was packed. And then you also had a giant HVAC conference in addition to the trading conferences, so it was pretty pumping. Vegas was a no short supply of spenders. When you cut rates in an economy that's already in solid shape, that's an additive to the economy. And when you have economic positives being injected into the market, it makes sense for yields to go up as we reprice for a stronger future. So just be aware that the Fed can cut and yields can go higher. Also, notably, though, the dollar is a little changed after getting hit yesterday, so I wouldn't panic about the macro too much just yet. All right, we've got Mr. Brent Kochuba joining me here to take a look at some of the flows. Obviously, you've got to be watching options and some of the big trades that we've been monitoring, which have been generally quite constructive. But a little bit of a breakdown here today. Brent, should we be concerned? Tell me what you're looking at.
My bad, Oliver. Sorry.
Hey, there you go. Yeah.
Mike, I was so stunned to see the handsome Noel Smith in the waiting room. I've been all thrown off. So.
Yeah, exactly.
Yeah,
I was supposed to go. I was supposed to go skiing and/or snowboarding with him when I was out in Vegas last week, but I got a little busy, and then I just didn't want to get hurt again. Last time I hung out with that guy, I had an injury for a month.
He's a dangerous man. Yeah, I gotta watch out. Don't do that. Don't do action sports with him, and don't bring your wife around him. That's what. He's a good dude. Sorry, but anyways, back to the non-muted point. On Wednesday, market was rallying quite a bit, and two week out, 3 week out, 20, 25 delta calls were trading at like a 9 or 10% implied vol in the S&P, which to me are pretty cheap. And we were talking about the fact that those were looking pretty good. Now, the next day, Oracle reports, market goes down, and everyone's like, Brent, you are a total jerk.
You did say, barring
rally,
some unforeseen incident with Oracle, you did point out that was the only risk.
There was the unforeseen incident.
Yeah.
And then yesterday, I'm the people's champ again. Market's ripping back. We closed just shy of all-time highs in the S&P, or at least the intraday high in the S&P. Things are looking good for those cheap calls again. And then, here we go. Avgo now down 11%, 12% now on the day. If you look at the weighting in the S&P 500, it's about a 2 to 3% weighting in the S&P 500. So that's about 35 bips of negative performance for the index itself right there. So, that is quite a bit of drag. Now, the thing that we noted this morning was a couple of things. Number one, those calls that were cheap, the 25 delta calls for the end of the year, that actually shifted down. So the calls that were continuing to be cheap were actually higher in delta. What does that mean? That it looked like people were selling more calls, or just vol was being more suppressed in that kind of 6,900 area. Now, of course, the market did spill quite a bit lower here. There's a lot of intraday 0DT activity. But the one thing I would take away from the way that the market's trading today, and I'm going to sound like this permeable, is that vol is not really doing much. I'm going to look at Noel to see if he can confirm that, or maybe tell me I'm wrong on that read. But we just don't see like a big lift in skew. The VIX is 15.8, which is kind of like a 1 month low. It's not really doing a whole lot right now.
And at the top of the show, I almost misspoke because I saw the high of the day, 18.5 for VIX, but then it's actually come down even with stocks down 1%. So I'm with you on that. That is kind of interesting.
And the problem for buying puts at this moment and holding at least shorter dated puts, where most volume is in the next 30 days, is we got the weekend right now. Then you got next week, you got OPEX, VIX expiration. Yeah, there's a jobs report and a CPI report, but those just give way to Christmas and in the holiday period, and then you also have obviously New Year. So it's just this holiday period where people are looking at their eggnog and whatever else, and not necessarily wanting to carry, puts over that period. Doesn't mean that things can't break. It just means that it's a struggle, I think, here, because that seasonality is just not there. And if you do look, there are statistics that support this just being a bullish period. So, I understand at this point, I kind of seem like Boyle cried wolf with the, hey, I think this thing's going to rally up to the 7,000 area. We do have that JP Morgan position for 12/31 expiration. There's about 70,000 calls, hedge fund or buy side calls sitting at that strike for the end of the month here and the end of the year. So, again, yes, we're taking a chip on the shoulder here for sure. If we break 6,800, that's the level where I think the negative gamma would start to spool up, and you'd start to see vol move in a meaningful way to the downside, where, to quote Princess Leia, hope, where hope is lost, right? And 6,800 is the only thing that could save us, I think. And so, that's what I'm really watching. Last thing is, yes, Avgo down 12%, Oracle down 12%. The put skews in those names are not really lifting all that much either. We saw a lot of evidence that people were selling puts or were short puts into these reports. Now, the stocks are lower without a doubt. That kind of tells me one of two things. Number one, people are not wanting to buy puts, which is fine. But since the stock is getting so beat up, or these stocks are getting so beat up, obviously that just speaks to the fact that maybe people are just cutting, and this story is kind of dead, which is a concern for markets, I think, largely more into January maybe than right now, just because we're fighting these seasonals. So all in all, I don't feel great about saying that it doesn't look like there's a lot of panic in this market right now, particularly when you have market leaders like an Avgo down, so sharply. But we just don't have that whiff of panic in the air yet, and the weekend can possibly break this momentum. Now, if you go into the weekend and then there is something weird like Venezuela being, troops in Venezuela or some other kind of crazy thing like that, then, obviously we have to change our tune. But I think as long as we hold this 6,800 level, we still got to think about 7,000 into year end, which is only about 1 to 2% rally, or, a little bit closer to 2-3% rally into the end of the year at this point.
It seems so close, but also, the kind of fact that you've got this big sell-off today in a pretty important name like Broadcom, and VIX is 16. I think that's a good point. That just shows that there's not panic, but it also does remind us, I think, Brent, something else that we talked about, which is that even though trend has been in our favor, the big call wall, the big strike positioning that's built up around 7,000 might make that a tricky spot to get through. But the flip side of that is once you do, and this is what you were telling us the other day with calls looking fairly cheap, is that if we can power through that wall, then it could be a real kind of home free kind of a ramp, a big push deeper into, the sevens.
Yeah, I think we had to close kind of above that 6,900. It's like if you give me the 6,900 close, then I think we can really pull into that 7,000. And why are those calls so cheap? In my view, up in that 6,900 to 7,000 area, I think it's because of this JP Morgan position. The whole world knows that there's a big dealer long there, and I think that does squash some of the vol into the end of the month. And again, I'd be curious what Noel will say about that. But, at the end of the day, that is a volatility suppressing position, and that should help to lift the equity market. Now, of course, if you have 35% of the S&P 500 and even more of that in the NASDAQ directly tied to this AI semi story, and that story is taking it on the chin in a major way right now, it's going to be hard for the market to rally in any material way, right? So there's not a whole lot you could do about that. And on that point, IWM looked like it was about to break out, right? I don't know you call that in technical analysis land a shooting star or something where it's like, hey, we break to all new all-time highs, and then we just kind of reverse violently. So while what was looking like an equity rotation kind of out of tech and into maybe some value names, that story or that narrative is also taking you on the chin a little bit here just to see both sides, where IWMs are now down 1.5%, which is obviously, not looking great for the equity market as a whole. So that correlation, which was kind of muted, maybe seems to be spiking a little more now to the point on rates creeping up, and that being a tough story. The other thing that I would note here that is also kind of interesting is you were talking about gold and silver. If you go onto Twitter at all, what you'll see is people saying that JP Morgan's going to go belly up because of this silver move, right? Which is just a bat, what narrative. And on that point, we were talking with my friend Jack at OpEx Effect, and this morning we were talking about this, and it was kind of funny because we were talking about silver and the idea that for JP Morgan to go belly up, right, you'd have to have just like let's even say that could be true. What happens when these entities get into trouble in these types of moves? A belly? Yeah, well, they probably don't. But to the point is the rules of the game get changed, right? And so if silver ends up in this place where it's going to cause financial institutions to drop, et cetera, the rules of the game change. What does that mean? You change the margin, and if you remember the famous Hunt Brothers story, that's what they did, right? When the Hunt Brothers had the market cornered, then all of a sudden the rules of the game change and it squeezes you out of position. The reason I bring that up is because the margin rates for silver changed this morning, and look what happens now. That totally clips that move, and now you're seeing a pretty big reversal there. I think in sometimes these situations, you get a little bit of cross-asset volatility as well, where this stock is driving miners and it's driving some of the small cap movement, and then when this sort of reverts, it does bleed over into some of these more speculative equities that could be, profitably or moving kind of in kind, right? Some of these gold miners, et cetera, which can help this small cap rally. So, you just lose another little bit of a leg of the stool there. And silver vols were coming down. That was something we talked about in our founders note this morning. So, some mean reversion there. It's sort of like we're looking around, we're like, well, where do you want to park your money right now? And there's not, necessarily a clean place. So, ultimately, again, as long as we're above the 6,100 level in S&P, I still think that, I'm still going to favor the bounce. I'm still watching that 7,000 level. But we lose that 6,800 level, and I think that's the signal that, okay, we could have a sustained kind of drop. Because lastly, just to the point, you were looking at the candles here before. Mm-hmm. Wednesday, we were way up. Next day, Thursday, we're way down. We just keep bouncing back and forth here. And so it's a little hard to find some consistency. Yeah, it's very hard to find some consistency there. So, again, 6,800 is a level I think we got to watch. It's hard to carry these puts over these next 2 weeks. And so if I had to be a betting man, we stay relatively stable into end of year, and then maybe January brings a little more bah humbug than we'll see in the end of the year.
Okay. A few points I wanted to make with regards to the flows that you track on SpotGamma. One is that it's a pretty good way to see what is hot and what people are talking about by looking at your tape function, which gives us the options volume, total gamma notional. And to your point about SLV, it's right up there alongside some of the hottest, tech trades. So, point taken there that people are starting to kind of get a little conspiratorial about what's going on or what the impact of that might be. I think just generally it followed the move in gold. GLD still seems to have quite a bit of gamma pull and what's generally been in the right direction, I guess. Then you've got some of your stock specifics like Broadcom and Lulu up in here that have been going, big today. But
massive trades there, yeah.
Yeah, but the fact that Tesla and NVIDIA have also been having massive volumes behind them, and those, Tesla's up today, by the way, and NVIDIA, which is down is still at its recent lows. So if NVIDIA breaks down below 175, I might start to get a little bit worried that then some of that kind of options momentum might have a negative effect. But so far, it doesn't seem like it's negative, Brent.
Yeah, and NVIDIA just sees a lot of call selling. I think if you think about NVIDIA, most people own NVIDIA, either directly or they own it through their holdings of the spiders and the Qs. And we all know that call selling and income trades are so popular now. And so if you look at the flows in like an NVIDIA or an Apple, I think people hold it. It's an institution, and they sell calls against it, trying to bring income. And that generally suppresses the volatility in those names on a relative basis. So I think they're just oftentimes a little sleepier in terms of their volatility or their beta to the S&P. And so, to your point, there is a moment where maybe this thing starts to break down. And is that NVIDIA 275? I think that's possible as a level where it starts to give way. But the point about this call thing is the more you move, kind of the more stability or the less stability you have as you start to bleed a little bit lower. So, it's like a slide, right? The slide starts slow and then it kind of picks up as you move lower. And so you can't arguably have the same sort of shock, I would say, as like where you have AV go down 11% kind of out of nowhere, right? It's a little bit different. So to your point, it's still pretty flat. Tesla, that's really big volume for Tesla. They have several million contracts a day trading anyways, about 3 million contracts a day. So it's on 4 million contracts, and stock is up in a very weak tape. It's up nearly 2%. So that looks pretty good. And then again, that AVGO volume just very large. If you don't mind looking at Trace, I just want to show one really interesting position here today, Oliver. And if you go back to about 9:30 today, and we talk about the impact of zero DT options, and I wouldn't call it a sleepy tape, but I don't know that it's all that busy. Behind you doesn't sound all that busy, but roll that tape back down there to about 9:30, right? And what you're going to see is on the left, you're going to see a giant position come in around 68.40. See, it just clicked right in. It's right there. And this is this daily condor position that gets traded. And when that hits the market just it just plummets, right? Drives straight to that strike. You get a short-term bounce, and we break through to 6,800, but then we kind of mean revert back up into that strike. And so, you can watch the timing of this thing hit the tape and watch the market reaction around it and sort of this mean reversion, mean revertive behavior into it. And so, when you look at, obviously we're down 11% in some of these big semis, and that's never good for the market overall. But you see just these sort of kind of escape or real big jump moves in the market when these zero DT positions hit, and that's a fairly sizable position just to come in, out of the blue, and the market seems to kind of be respecting that a little bit. So I think when we have a big 1% drop and then we sort of just trend sideways, you look at that zero DT position as something that's a little bit sticky. I mean, you can see how the market seems to really kind of revert back into that level, like a little bit of a magnet. So we're obviously going to lose that position at the close here. So, I would think that we're either going to kind of make or break on Monday. Either we're going to be up over this 6,800, then that vol is going to come down, or maybe, Monday finally brings the capitulation. And if we lose at 6,800, then we got to start looking at like 6,600 as an area where there might be a little bit more relative stability.
Might be time for one of my favorite gambler trades, the Stringle or the Straddle, depending on how you want to structure it, but just betting on a big move of any kind, which is oftentimes an expensive position to put on, but with vol as cheap as it is and, range bound, it might be a decent way to kind of bet on just a big move in general, though I would still think my bias would be to the upside. But that's kind of the idea, is that vol's still pretty cheap. I think on that point, time to get Mr. Noel Smith's thoughts. Brent, great stuff.
Thanks. Enjoy your weekend.
Trace, you as well. Like to see that big wall of activity and options that was able to kind of hold us in after that initial drop this morning. Good stuff, Brent Kochuba. As always, joining us from SpotGamma, taking us through a little trip into the platform as well. I got Noel Smith joining me, Convex Asset Mgmt. Noel, sorry missed you in Vegas, but as you heard, I had to prioritize my health this time.
Yeah, well, I'm glad you didn't get hurt. I did have a secret weapon for you. I have gloves with wrist guards in them. So people, when they get hurt snowboarding, they usually fall forward on their hands. So I was going to give you these gloves so you didn't get hurt.
I appreciate the thought. But hey, I was thinking, all right, am I going to snowboard for the first time, or am I just going to stick with the skis? But then I got kind of buried in the annals of the Wynn Conference Center. It was World Poker Tour and trading conferences. I was kind of in the zone. But I did pack my ski pants.
Nice. You're doing all this crazy stuff in Vegas, and I'm at like my kid's soccer tournament.
Well, that's because you're a well-mannered adult man, and I'm going through a degenerate phase.
I'm an adult. Leave it at that.
Noel, tell me about why vol's so low here, despite some of our key structural AI trades kind of blowing up. You know, like Broadcom just getting blasted today. I know it's maybe not as important to the narrative as NVIDIA, but Broadcom's been having a great year. How come the market's kind of volatility, at least, is going through this unfazed today? Tell me what you're seeing.
Yeah, I'm with Brent on this. I think that, if you're just going to go on the numbers, I don't think there's a whole lot to do here in terms of panicking. I can say that I did add to the hedge today. That was really more just luck because I did that on the open. I bought some VIX calls. I also have some very, very wingy NVIDIA puts. Not a commentary on NVIDIA. I don't think NVIDIA is going to zero, but I do have them because I don't think they're that expensive. And I don't see my hedge book working at all with NVIDIA being up here. In other words, I think NVIDIA has to be part of that. So HYG was another one that I did a little bit of put action in. Again, that's more of a commentary on the private credit situation. I think credit vol is low. I think HYG volatility is low on an absolute and relative basis. And with all this low vol, I decided to buy some VIX upside, YG downside, and some extreme downside in NVIDIA. And I'm still fine with all those trades.
Well, I like the point about HYG, actually. I'm glad you bring that up because maybe the more notable move to me today is the fact that 10-year yields seem like they are trying to push higher, actually, which I've called the bizarro bond market. We cut rates, but yields go up. And that could put some pressure on the HYG category for your puts.
Yeah. So, you've got this First Brands debacle. You've got rates moving. You've got the market going down with not much of a vol response. And you've got the, Oracle and Broadcom news. And that's kind of what's driving the market. So is that enough to tank us into the new year? I have no idea any more than anybody else. But I can say, just looking at the numbers, Broadcom and NVIDIA account for over 30% of today's move. So absent that, you've got the names that are helping: Tesla, GE, Lilly, Netflix. So it's not that crazy of a day, and I don't think it's a day to panic. The hedges that I put on earlier today are a hedge trade, not a market go down crash decision.
Tell me about the difference between those two. Is it just the moneyness, the strike that you're looking at? Is it the time? How do you make that difference between kind of hedge versus speculation?
Hedge means I have really no opinion on vol path, which is to say that I don't know if vol is going to go up steeply or not that steeply or very slowly. And vol path is, I don't have any idea how to predict it. In other words, if somebody comes up with a COVID situation or a tariff situation, I don't know any more than anybody else if the VIX is going to go from 15.9 to 50.9 in a week. That's a very difficult thing to know. But if it does happen, I know that my book will remain robust to that.
Okay, so the path versus the kind of general direction or the specifics of it. Obviously, this is going to depend on what any person's got in their overall kind of holdings and where the meat of their position is. What about the fact that we've just got kind of low vol in general? Does that lend itself to maybe kind of looking for a big move? What do you think my idea of putting like a strangle or a straddle on something that just says, hey, we've been stuck in a range, I think we're going to break, I don't know which direction?
Low vol will often beget low vol. And if you look at some kind of a smoothing mechanism within volatility does tend to cluster. So if the idea is that every time VIX goes to 16 or lower, we just sell a bunch of strangles, that's hard. That's a very difficult trade. I was looking at the SPX end of month out of the money calls. If you look at the 7,000s, it's only like a 9.4 vol. It's a cheap option. It's a cheap vol. And I'd rather have a long call spread as opposed to a bunch of Delta One instruments because the vol and the vol spread between the at the monies and the out of the monies is pretty slight. You're looking at less than 3 vol points between the at the money and the 7,000 strike in SPX. I think that's a safer bet.
Okay, all right, nice. Noel, thinking about the timing, the calendar, the year-end expiry as well, how does that factor into the way you're thinking about volatility right now? It's December 12th, and obviously we got holidays, we got year-end stuff, quarter-end. and expiry as well for many of these contracts?
Everybody knows the same stuff. Everybody knows there's a bunch of holidays. Everybody thinks that people are taking off work, but if that means they're not. And so there is usually a little bit of extra volatility in a less liquidity environment. If people really are taking off, there's less people to do things or to do the opposite side of those things. So it can exacerbate vol a little bit. So I think vol at 16 with a 1% move in the SPX sounds pretty fair. You know, you're basically getting realized right at implied. And as we march forward into the holidays, I just, like Brent was saying, do you want to really pile on a bunch of theta right now? To me, that just feels like a losing bet.
Yeah, that's fair. Somebody in the chat asks, will there be a Santa rally? How do you... people have different definitions of it. Mine is just kind of, do we close out the year strong? There's also the January effect, which some people point to in small caps. I think that more likely than not, like I've been saying here, is that, and to your point, it's not a panic day. It's just you've got a big hit in an important stock, and VIX is subdued. The market's only down 1%. It's within a range. That tells me that generally the trend still looks higher. So yes, Santa Claus, but at the same time, I might also say that, you know, in IWM, a small cap world, you might be able to find some interesting ways to kind of trade outside of the big tech stuff for a moment. I'm curious if you've been watching any of the volatility there at all, or if that appeals to you. Noel, IWM is getting a hit, Russell down 1.5%, but there's also that kind of potential for, I think, some people looking for rotation, as they call it.
You know, the market's so concentrated at the top, and if you look at the names, I think there's about 50 names that are in this little AI world, in the AI orbit. And those 50 names account for something like 50% of the gains since OpenAI came out. And the idea that we can march forward without AI repels common sense to me. And can you rotate into emerging markets, Russell, or whatever? Sure. But is it sustainable? Do I think that the Russell goes up 10% if the S&P 500 goes down 10%? I do not. I just don't think that happens.
Yeah, I'm kind of with you there, right? They can get disconnected for some time, but to suddenly think that the major catalysts that have been behind this, that we can pivot, it's a pretty tough juggle to do. That's a pretty hard, switch to do. I always think visually, I make this reference a lot, but that scene from Raiders of the Lost Ark, the OG Indiana Jones movie, where he's got to take the artifact off the pedestal that's got, the connection to all the stuff, that the arrows that are going to shoot at him, and you replace it with a bag of sand, at the same time. So you've got like all this big tech stuff that's sitting there. What are you going to replace that with? Every stock in the Russell 2000, especially to your point about HYG, and my point about yields is, that's the type of stuff that can be a bit of an impediment to groups like regional banks and anything in that small cap world that generally carries more debt. People are
Absolutely.
kind of making this big statement about all the tech companies are spending too much or spending so much. I'm like, dude, they've got ridiculous cash. They're not doing it with debt. It still seems like the best kind of fundamental, situation as far as kind of classical discounted cash flow stock analysis, that these are the best looking, fundamental high quality companies too. So a short on HYG to me is sort of also kind of an implicit doubt in some of the small cap world, but I might be stretching there. What do you think?
Yeah, it's also a very low vol, very low dollar value option. So the punishment for being wrong isn't that high, depending on your size, of course. So that's something, I'm not saying be short HYG. I am saying that if the AI narrative blows up, I think that credit doesn't become unscathed in that environment. And today, if you look at the yield curve, it's steepening. You've got the 10-year up at 420, give or take. And the steepening effect of that, I also think is a little bit of a problem. But if you look at the vol in the bond market within the ZN futures, ZB futures, not that high. It's not that risky. If you look at like VXTLT, again, it's not really moving much. If you look at the move, which is the bond vol VIX kind of, it's not really doing much. I think it's at 69 or something. So there's just really no cross asset vol other than silver and gold. Fine, they were up and now they're down. Those are the only things that are really, from a vol standpoint, moving a ton today. But everything else, oil, all that stuff. Really, it's not that big of a deal. I just don't think it's, the world's on fire.
You know, the TLT chart, which offers obviously a wider range of bonds than just the 10-year yield, which of course is just one tenor. The TLT does look now like it's trending lower. I'm glad you actually bring that up because obviously you've got a very popular product here and one that gives you a broader look at bonds than just the 10-year. So, going further out in duration, the 20 plus looks like it's trended downward here, Noel. And I think a lot of people that throws them off, they go, the Fed's cutting, why are yields going up? Why are bond prices going down? But that's been happening for 3 years, basically.
Yeah.
When the
Fed doesn't have any control.
Cutting. So,
the Fed doesn't have any control over the 20-year bond or the TLT or something like, or an artifact of the TLT. What the Fed can do is it can lower, the overnight rate or raise the overnight rate. But, those instruments in the back end are freely traded. And, if the marketplace thinks that Trump is going to run a hot economy, whether that be through Powell or Hassett, whomever, those rates can go up to do that. And then also if you say, well, then maybe they'll do something like an Operation Twist to bring down the 10-year so the housing market doesn't get pounded, well, then that goes back to the dollar short. So there's only so many different legs of this stool. Eventually, there has to be some kind of a reckoning or accounting for the largesse that the government's doing.
Yeah, fair point. I don't disagree with that. I also think there's like an Occam's razor kind of even simpler one, which is, like I said, I just got back from Vegas. It was packed. It's the economy, our jobs numbers, have been okay. I know people have pointed out that some of the kind of AI displacement might be showing up. There's a productivity argument there that's encouraging. So I just look at an economy that seems to be okay, stock market that's close to all-time high, well, technically making them basically, and then you cut rates. So if I'm going to bet on the direction long-term of the economy, I'm generally going to bet on growth, which means I'm going to sell bonds, and I'm going to want to buy these companies. So part of me too is I don't think it has to be a negative thing necessarily.
But that speaks to the K-shaped economy, right?
Sure.
You're hanging out at the win doing win people stuff and rich guy stuff. So what that means
clear
is
the win
that
side,
really,
not the encore side.
right?
I was playing the $25 table, not the $300.
That segment of the world is doing just fine. I went to dinner last night at a nice place and it was packed. People are buying $300 bottles of wine left and right or whatever. But that divergence is still happening, and people that own assets might continue to do well. But the other side of the world that doesn't own assets or are in a more difficult position, that spread might be widening.
Yeah, well, that's why I hate to plug everything that we're doing here, but that's kind of the whole point, is that as time goes on and AI and tech does more of the heavy lifting for the economy, you've got to be invested. There shouldn't be these different classes, right? That's kind of the beauty, the whole purpose of the Robin Hood concept, and I think why that stock has been so important in what they're doing, which is financial education. That's kind of what Chicago's the home of, which is getting people involved. Like you don't, like I tell people all the time. I was talking to my barber a month ago, we were talking about the exact same K-shaped thing. I've known this guy for years. I'm saying, hey, dude, you've been cutting my hair for years. You know what I do? Download Robinhood, park your, extra every week, even if it's a fractional share. And he goes, well, what do I buy? What stock do I buy? I go, well, you just I'll buy all of them. Buy the S&P, and that adds up. You increasingly doing that over time is just, everybody's going to have to, you know what I mean? So obviously some people have started out with a much farther kind of lead than others, but still that's part of the future. Is you got to be invested in the future, and it's the hedge to it. So I hear you, but at a certain point, it's like you can't force people to do it. I can't force people to go and download and just buy an S&P and sit on it. But I'm trying to preach to the world, do it.
I agree, but if you look at the equity markets in periods of inflation for other economies, they've actually done in a local currency term really well. If you look at the Deutschmark during Nazi Germany, if you look at the peso during Argentina over the last many, many decades, they've done well notionally in local currency terms, but that doesn't necessarily mean that they've done well in absolute value terms in terms of the amount of goods and services you can buy across the world. So I do think that people should have investments in assets, but if they don't have the discretionary money to have anything outside of what their day-to-day needs are, that's a problem for those people, and that does widen that divide.
Yeah, no, I mean, hey, that's very true, very true. Noel, great conversation, fun stuff, nice, good analysis of volatility from VIX into the kind of socio-political economic discussion around rates. Fun little tangent there as we have stocks with about 23 minutes left, still in decent shape, but definitely getting hit today. We are kind of slipping, but the vol 16.2 is just still pretty quiet. So no panic, I think, is the conclusion. From this, we're still off the lows of the day, by the way. 6,800 is the low. Is there an area that you do start to describe it as panic, Noel, real quick? Where that hedge might turn into a bet?
I don't look at panic in terms of a level. 6,800 makes sense of a cluster of options. So the idea being that we go from a positive gamma environment, if best that can be known, into a negative gamma environment. The idea that sellers will beget more selling. There's some merit to that idea. Those are difficult numbers to really know for sure. But if the idea that there's a bunch of puts that are short in the marketplace, and then all of a sudden people have to start selling to cover those deltas, yeah, that's a real thing. But is it magically at 6,800, which is 11 more SPX points? I don't know.
Yeah, hard to know if there's they say they don't ring a bell at the top, but they also just don't ring a bell anywhere. Well, other than here in about 22 minutes when the market closes. All right, you man, great stuff, Noel. Good to see you.
Great.
Catch you
Thanks
next
for
time
having
in
me.
Vegas. Appreciate it as always. Noel Smith, Convex Asset Management. All right, we got a break real quick. Got the innovator buffer break. We got some questions in the chat. I'm gonna come back, answer a few questions. Pretty good observation by someone about the pattern technically in the S&P 500. I'm gonna give a quick thought on that. Also, my tweet or X post of the day that I think is a really great graphic. So, short break. Then we'll be back, and Scott Bauer is going to take us into the closing bell. Stick around on Chicago Future Finance. More ahead.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction. With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% trap? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. We got a couple good comments in the chat. I'm going to hit real quick as the market is indeed under some stress today. S&P 500 down about 81 points, but we're off the low of the session, so it certainly could be worse. One interesting note on the YouTube chat, by the way, Chicago, at Chicago Future Finance. Give me a question. Derek Cheney says it looks like pretty classic Wyckoff distribution to me, the chart of the S&P 500. That's a pretty interesting thought. Which I want to address real quick, because Wyckoff distribution is sort of like the classic technical bearish behavior that you look for if you're thinking that a range will resolve to the downside. Now, I don't think there's quite enough evidence to the point of Noel and Brent's conversation that this is going to resolve to the downside necessarily, but the point of the back and forth certainly does kind of bring up notions of overhead supply being too much to handle, which is essentially the core of the Wyckoff analysis. By the way, if you haven't read, and I certainly haven't read all of it, but in my study about bearish divergences and my research into patterns on crypto, which is the pure speculative asset class in my mind, I ultimately did find there to be a lot of truth in the Wyckoff distribution understanding of technical events. It's also something that I learned under Ben Lichtenstein, who was kind of my technical instructor back in the day at TD Ameritrade and Schwab. So, that's my chart of the day. Hold on. Here we go. Here's, boom. This is what it looks like, basically. And I don't think we're quite there yet. There's definitely some signs of maybe some overhead supply for the S&P 500, but really all we've gotten is now maybe one lower high. So I'm not super concerned that this looks like something that's going to break down necessarily. The phases of the Wyckoff distribution and sell-off, the implication is that it ends negatively. So where would we be in this? Perhaps in something like a phase C or a phase B? I just don't know if we have quite that evidence of it just yet. If you flip back and forth between that chart and the S&P 500, you see some similarity, but I wouldn't get super hung up over it. What I generally am going to see more in this chart is if you zoom out. Obviously, I've got the support at 6,600, which does kind of look like the baseline of that kind of Wyckoff support that then could break to the downside. But I would rather just say zoom out and look at generally the trend, where I'd much rather draw an upward and to the right trend line that gets us to where we are with very few violations. You know, here's generally the pattern. The sell-off in November certainly threatened that, but overall, it's up and to the right. And then, of course, just here, even most recently, yesterday, we literally had a higher high compared to November. So you really only had one lower high relative to the record from October. So I'm not super concerned about this being kind of that distribution pattern. The other thing as well is that the Wyckoff distribution, in my understanding of it, does show up very much when you look at bearish divergences. And we haven't had a bearish divergence here for the S&P 500. Just want to pull up RSI real quick so you can see what I'm talking about. You've had to some degree, okay, fair enough. If you look at actually the RSI, you do get a bit of this bearish divergence where the RSI is moving lower. It goes back to July, so in theory that could be, a warning sign. I don't want to get super hung up on it. We have had a few under 50, so maybe there is some truth into it. Some of this RSI that's been declining is certainly not an ideal thing to see. It's actually notable, so maybe a good point on the distribution potentially. But this juncture, I'm thinking more about the trend that has been constructive. In particular, if you look at the leading sectors for the SMH, little bit of bearish divergence there as well since October, but still a chart that I'm thinking more about higher highs. You put in the higher high for SMH at 375 versus October at 368. So that's a pretty clear trend to the upside. That then brings me, I think, to my post of the day. I still can't not call them tweets, but this is the post of the day, which I think was really good. This came from Leverage Shares, which puts into perspective the role of market cap in the market right now and the performance of the S&P 500 as ranked by market cap. This is a pretty fun way to look at it. Start with Palantir to figure out where this chart is going and how it works. So the size of the bubble is the market cap for the company. So Palantir, obviously a smaller market cap, significantly the NVIDIA, Apple, or Alphabet, the big names in the Mag 7 in the middle. But the return here on the right side shows massive returns. So your x-axis looking to the right is performance. And then the size of the bubble is the market cap. And obviously this is, again, the story of a concentrated market and a market that has very much lived up to the sort of academic expectations of skewness in markets, which is something I wrote about early on in my career, which is that the market is driven by a handful of names, which is why most investment managers underperform, because if you miss a few of the key names, then you basically miss the entire market and you underperform. So that is, I think, a really important notion here, that you've got 1, 2, 3, 4, 5, 6, the biggest 7, the Mag 7, is still the leaders. And for a lot of people, this is just something that bothers them. I don't think it should. As I've said before, on an infinite time horizon, as tech does more of the labor that was done by people in the past, you're going to have to keep up by investing in the companies. And that's how capital markets work. It should accumulate among the companies that are doing the best and the most disruptive. That's just the way it works. And also remember that these companies have purchased a lot of other small businesses along their growth route, which means that they're not just one-trick ponies. So I think this, again, does a great job of showing us really how different this market, or how powerful this market is, rather. Different than in the past, but consistent with the last couple of years here. And that's been really the story of the strength for this market. So don't hate market cap concentration. Obviously, it means that if any of these break down, that you have to be wary of it. But I would say that I'll end kind of this segment with the chart of the NVIDIA, which is going to be really important, I think, to watch next week. Because SMH put in the higher highs, but obviously NVIDIA did not. And NVIDIA has been really struggling to make a big move, and now threatening 175. I think you might get a little concerned. And maybe the yellow light on stocks will have to turn red if NVIDIA breaks down, but I think more likely still the case is that light's going to be going green as stocks break out. But it's not going to happen today. It sure doesn't look like. I got Mr. Scott Bauer joining me for Prosper Trading Academy, taking us in here to the bell. Scott, how you feeling after Vegas? You rested up? That was a heck of a time we had out there.
No, I'm not rested up, but yeah, it was a great time, and hopefully everybody enjoyed it and everybody got something out of it, which I think they did. And thank you for helping us out and being a big part of it.
It was a great time. It was fun meeting folks. It was fun learning the way people are hedging their own books, their own wealth. I think so much of what we talk about here on the show was right smack in the middle of what you guys were talking about at the conference, which was generating income off of big tech positions that you've had for a while, or a portfolio that's done well. And I think days like today, also kind of reiterate that point, which is if the chart of your stock or your portfolio isn't going straight up, it doesn't hurt to collect some income off that, sell some calls. At days like today, you look real smart.
Oh yeah, no doubt about it. And I think another big thing is, people get really panicked on a day like today. In general, if you're retail trader, or you're just looking at your portfolio, which you should not be doing on a day like today. And one of the things that we certainly talked about, and you lent a great hand to this also, is that you can't look at things on a day-to-day basis. We talked about the emotional side of trading, the psychological side of trading, and certainly a day like today can give people the jitters. And getting together with a group of professionals that have collectively been doing this for well over 100 years, I think really helped that side of things for people. Besides talking about strategy and wealth income and all sorts of other things, we all know that the emotional side of trading can really be the blockade to someone being successful or not. So I think we really helped out a lot there.
Yeah, no, I'm with you. The other thing we talked about, Scott, is kind of when generating income is favorable, and when it works best and when it's not. I will say one of the things we've talked about today is that volatility is still pretty darn muted right now.
It really is. It really is. Looking at a VIX of 16 today, and I think that is reflective of there not being a lot of concern going into the end of the year, at least over the next few weeks, that this is just really the reaction that I would have expected after the announcement from the Fed on Wednesday, not the ratcheting up as we saw, because I didn't see really any reason to be bullish off of what Powell said. How many times have we talked about this, Oliver, that, be careful what you wish for, and them lowering rates? Why are they doing it? I don't see why they needed to do it if they're looking at the macro picture. I think there was too much pressure on them not to do it, but are they doing it because the data under the hood is not looking so good? So to me, this is what I would have expected more so than what we got on the reaction Wednesday, and even the comeback that we saw yesterday.
What's interesting too is that yields, we talked about this in Vegas, yields are now trying to move up, which
we sure are.
We talked about as a real possibility, and now here we are. So I gotta say, the 4.2%, kind of looking more like it might break than revert lower necessarily.
We were talking about that, and we identified obviously 4.5 as really that big line in the sand. But if we get to 4.5 again, that's not going to be good for the equity markets. But right here at that 420 area, you and I were discussing, where is it going to break from here, up or down? And you're right. I think the momentum right now is a continued sell-off, meaning yields go higher.
Yeah. If we do, is that going to be a problem? Do you think that's adding to any of the tech weakness today, Scott? Or
absolutely no, it absolutely is. I think Broadcom obviously was not helpful in the least bit, especially coming after the Oracle results the other day. And then you got that, and then the look at what's happening with rates here, and it's kind of the double whammy, if you will. And I don't think that we're necessarily in a gloom and doom or a bear market for these types of stocks. I look at them more as an opportunity to kind of reload and get back in long term. But I also think you have to do that with a little bit more caution, right? I don't know that anybody should expect 20, 30, 40%, to the upside from some of these stocks that have gotten sold off. But to me, the narrative really hasn't changed that much.
Okay. I think that's been the consensus here among the future finance contributors today. And I think we're all kind of looking at the same stuff, which adds up in a very logical argument that a little pullback and a pocket of weakness and a narrative that, doesn't afford a lot of room for negative news. So when you have like an Oracle or Broadcom give anything that can be construed as negative, I can see why, people get a little quick on the trigger finger, especially for a stock like Broadcom. It's had such a big run. But that's kind of where I come back to NVIDIA, where I do think we kind of have to rank by importance. Not all AI trades are necessarily the same. Whereas I think if NVIDIA were to break down, it'd be a lot bigger deal than Broadcom breaking down. And by the way, it's not to say that Broadcom hasn't been a monster. I mean, Broadcom's up, 100%. But the chart's still in an uptrend. If NVIDIA breaks down through 175, then we might have a downtrending leader here. And to me, that would be a much bigger technical event.
Yeah, that would definitely be more difficult. Broadcom's going to be interesting because where we're sitting right now at 360, that's 50-day moving average, pretty strong support there. I know we traded down below there for a little bit, just by a couple bucks or so. It's going to be interesting if we close right in this general area to see where that next move is come next week. Again, with this being some pretty major support there. We saw Oracle bounce off its lows from the other day, certainly given a little bit back today. I think next week we could see some buyers come back into the marketplace. It has nothing to do with Santa Claus rally or anything like that. But I think there still is an opportunity here to move higher into the end of the year. But I think, we have to do that with some caution. As you said, vol is still pretty low. VIX is still pretty low. So you do that and you have some of that protection.
Yeah. The cheapness of volatility has got to be a big story. There's, people talk a lot about stocks up, vol up, which was becoming a more frequent thing given the power of the call buying options community. But by the same token, stocks down, vol unch is a pretty interesting version of that, I realize that VIX has really moved a point, but it's at a very low nominal level. So that creates interesting opportunities.
I do believe that. I really do. And that's why I'm looking today as a day not to get super, super bullish, but as an opportunity to maybe reload on some of these stocks that have gotten hit. And listen, if the general backdrop changes, right? If all of a sudden we come in next week or 2 weeks from now and the VIX is trading 20, that's a different scenario. That's a different narrative.
Yeah, no, I agree with that too. And it creates totally different trades that you put on as well. The other stuff, Scott, outside of stocks, how about coins? How about gold and silver? I feel like for Bitcoin, it's just been sort of weak and soft, whereas gold and silver, I know silver's taking a little bit of a hit today, but, look at gold just kind of resuming back higher. So, there's some good stuff in here too.
Yeah, exactly. There was quite the reversal midday today, and then going into the end of the day, here we are. Gold is back up. Silver, I was just talking about this to some of my students. Boy, that the gold and silver really flip-flopped today. Lots of momentum that had been behind silver, and now we're seeing maybe some profit takers there. I absolutely still think gold is still the trade going into the end of the year, going into next year on a buy the dip until that narrative breaks. I was just talking to someone that has absolutely been my best trade of the year. Not an individual trade, but just kind of rinse, wash, repeat with that. And until that pattern breaks, I think you got to follow it.
Yeah, I'm with you. It just looks like one of the best charts out there, about to make a fresh new record. It's so close. Yeah. Something I guess we'll have to leave for Monday, as the S&P 500 does end right below the closing highs we put in yesterday. Somebody said in chat, Oliver, we made highs. I'm an intraday guy, Scott. If there's a candle with the high, then we're not at the all-time high. A closing base is fine, but what's one moment in time?
That's right. That is absolutely right. And it's so difficult for many people to just pick one spot on a candle, one spot on a chart, right? What is one moment in time? Take a more, a little bit more backward.
We're near highs. I'll say we're at highs. We pulled back a percent, but vol didn't pop, and we find out how the story continues next week. Thanks, Scott. Great job. You guys did a good job in Vegas.
Thanks again
for
your
help. Hit it out
help.
of the park
Great
for the first
weekend.
Conference, 100%. Scott Bauer, Prosper Trading Academy. There it is. You heard the bell. That's it. We are out. Have a great weekend. I'll see you on Tuesday.